Hi there, welcome to Kneppy Invest. The companies I tend to follow right now are not the same sort of companies I was following about 10 years ago. Now, about 10 years ago, I was really interested in a lot of story stocks. And then I started becoming less and less interested in those sort of companies. But I decided to have a re-look at these companies that I was following quite closely about 10 years ago. And the first company we're going to look at is Anteris. Now, I don't know this company as Anteris. In fact, I know this company as Allied Health, and then they changed the name to Ademis about 2013, and then about 2 or 3 years ago, they again changed the name to Anteris. Now, there are a lot of red flags when it comes to this business, and there is a reason why I stopped following this company, and that will become clear as I discuss this company during the rest of this video. But I'm going to have a look at the most recent quarter results just to see how this company has performed over the past 10 years, particularly over the past 6 or 7 years, because I really stopped following this company back in about 2015 or 16. Now, let's have a look at a brief history of Anteris, where it has come from. Now, there was a company called BioMD that listed on the ASX in March 2004. And then in 2005, another company called Allied Health was spun out out of Fortescue Metals, and that company was selling catheters. Now, Allied Health bought 38.6% of Ian Fraser's biotech Corridon, and then in June 2011, there was a reverse takeover of BioMD by Allied Health. And then in September 2012, and the reason I really started following this company was because they launched CardioCel in Europe. So I know Allied Health, which then became Ademis, because of CardioCel. And then in November 2013, they changed the name to Ademis. So I sort of equally know this company as Allied Health and then Ademis. And then I stopped following this company for a few reasons, which will become apparent later. And then after I stopped following this company, Anteris, for reasons which probably will become apparent, decided to sell CardioCel, the whole reason I started following this company, and VascuCel in October 2019 for $36 million. And then in May 2020, this company, which was Ademis, changed the name to Anteris. And I understand why they changed the name, because of the technology they have in place right now. And that technology has driven the market cap of this company up to over $300 million. So it's very important to understand what their technology is right now. So let's have a look at that aspect of this company. When I started following Anteris way back about 10 years ago, when they were known as Allied Health, they were focused on CardioCel, VascuCel, but being focused on those two bits of technology did lead to some problems, in particular cash burn. And then they sold those bits of technology, and this company has been focused on other parts of their business since then. And it has worked a treat because the market cap of this company is now over $300 million. So what they're focused on right now is a transcatheter aortic valve replacement, or TAVR, and their bit of technology is called WHOAH, which is a single piece shaped valve designed like the native aortic valve. Now, this company also has other bits of technology working for them, but this bit of technology, if it does work, is potentially game-changing for people afflicted with aortic stenosis. And I briefly mentioned they have other bits of technology as well. So they have the dual AV, which is a single piece aortic valve. They also have anti-calcification technology, which is called ADAPT. And they also have transfemoral delivery system called ComAssure. Now, let's have a look at some facts in regards to Anteris. They listed in March 2004 as Biomed. The current CEO is Wayne Patterson. Apparently, he only owns 0.1% of the company. I would like that to be a little bit higher. I would like there to be a little bit of skin in the game. One of the largest shareholders is if not the largest shareholder, is Perceptive Advisors with 11.9% of Anteris. And the current market cap of this company is $349 million. That's at a share price of $22.65. Now, I haven't been following this company for the past 5 years or so, and I was shocked to see the markup. I was also shocked to see the share price, $22.65. So when I started following this company, I think the share price was about 10 cents. So you might say, I should have bought shares way back then when the share price was 10 cents. But I can tell you right now, if I did buy shares back then at 10 cents, it wouldn't have benefited me. because even though the share price has risen, there has been two significant share consolidations. So back in January 2015, in fact, there was 1.8 billion shares on issue. And because of these two share consolidations, the amount of shares right now is only 15.4 million. And I'll talk about those two share consolidations later in the video. And the ticker code for this company is anything, or could it be anything else other than AVR. Anteris does a lot of capital raising. Seems like every single year they need more cash. This has been going on for many, many years. And because they can continually raising capital, increasing shares on the issue, this company has done two share consolidations over the past 8 years. The first one was in 2015. It was a 10-for-1 share consolidation. So the shares on issue went from 1.8 billion to 184.7 million. Then they did another share consolidation in 2020. Shares on issue went from 590 million down to 5.9 million. So you can see between 2015 and 2020, shares on issue actually tripled. And between 2020 and right now shares have gone from 5.9 million to over 15 million. So shares have almost tripled over the past 3 years. And that should show you that this company is continually raising capital. So even though I could have bought shares in this company at 10 cents back in 2011, I would actually be much worse off because of these two significant share consolidations. And you'll be able to see that when we look at the long-term chart towards the end of this video. So why is this company continually raising capital? Now, this company has been generating revenue over the past 10 years. You can see revenue really ramped up from 6.5 million to 25.6 million from 2012 to 2018. Remember, they sold CardioCel and VascuCel in 2019. So this was them being successful in selling CardioCel. But the cash burn in this company was absolutely ridiculous. And this is one of the reasons why I stopped following this company. In fact, this company has been burning through more than $20 million on a consistent basis. That's per year on a consistent basis. So in this particular chart, I should have mentioned this at the start of this particular slide. This particular chart, I'm looking at total revenue, that's in the blue, and cash flow from operations, that's in the black. And this company has been burning through a lot of cash. In fact, in the last year, the company burned through $39 million of cash, but only generated $4.6 million of revenue. And this is the reason why this company continually needs to raise capital. In this particular slide, I am looking at the markup of the company and the shares on issue on the company over the past 10 years. Now, the markup of this company has been a wild ride, sort of a roller coaster ride over the past 10 years. Now, when I first started following this company, the markup was about $20 million. And then the markup went as high as $220 million in 2014. And then there were concerns about the cash burn in the business because at that point in time, they were increasing the sales of CardioCel and the market was liking that. But there was those ongoing issues of cash burn. The market didn't like that. I didn't like that. That's one of the reasons why I stopped following this company. And then eventually the company sold CardioCel and VascuCel in 2019. And the markup of this company fell as low as about $25 million in 2020. But the market has really loved what this company is doing in regards to their aortic valve. And that's why the markup of this company has risen from about $25 million to as high as $390 million. But the issue I have with Anteris right now is this company continually raising capital. So 15 million shares on issue right now. And if they need to raise more capital because they're still burning through a lot of cash, the shares on issue will significantly increase from $15 million. And that's going to have a dilutive effect on shareholders. To have an idea how much this company is burning through cash, let's just have a look at their most recent Appendix 4C for the March quarter of financial year 23. Now, in this particular quarter, they received $1.4 million of receipt, but they spent $4.6 million on research and development, $7.7 million of staff costs, and $1.9 million on administration and corporate costs. So in those three areas, the spending was greater than the receipts from customers. And because this company is spending a lot of money just in operations, they burned through $13.1 million in one water. Now, in saying that, cash on hand actually increased in the quarter from 13.8 million to 31.8 million. So how did they do that? Well, capital raising. The company raised $34.9 million. Now, if this company continues to spend like they are, and if the receipts of customers don't increase, this company will have to continue raising capital. And eventually, this could become a problem for this company. If the market becomes fed up, just like they did back in 2015 and 16, because at that point in time, it was just the cash burn. The company just burning through a lot of cash, even though cash receipts were increasing. And if that happens again, I wouldn't be surprised to see the share price suffer and the market cap suffer as well. So let's have a look at the long-term chart for Anteris. Now, back in 2012, whenever I started following this company, the share price at that point in time was something like 10 cents, maybe even lower than that. I can't quite remember. And then we did see a nice little rally in the share price in 2013 and 14. And if you look at the chart, you'll say, well, the share price reached a high of about $180 in 2013. But remember, this company has done two significant share consolidations, 10 for 1 and 100 for 1, which that means or equates to 1,000 to 1 share consolidation, which means our share price of $180, was these share prices are adjusted because of share consolidations. That $180 translates to about 18 cents or something like that. So that's why, even if I bought in at 10 cents, I would be underwater right now because 10 cents translates, because of those two share consolidations, translates to about 2 cents right now. So yes, shares would have gone down fivefold if I bought back at 10 cents 10 years ago, because again, this company continually raises capital and they've done two significant share consolidations. That's all I have for this blast from the past in Anteris, a company I know as or knew as Allied Health and then as Ademis. And then I stopped following this company back in 2015 or 16, somewhere back there. The company was increasing their cash receipts revenue, but the cash burn was horrific. The market fell out of favor because of that cash burn. And then they sold that technology and they started focusing on another technology they had, which was their aortic valve. Seems like the market has fallen in love with the potential of this technology. But when I look at the most recent Appendix 4C, I see the same issues in this company right now that I saw way back in 2015 and 16, that they're not generating a lot of cash receipts, but they are burning through a lot of cash. They love to spend. Potentially this time it will be different, but I would be wary if I was a shareholder moving forward for this company, that this company will continually need to raise capital to fund their spending. So if you have any questions about Anteris or anything you've heard in this video, if you love the potential of this company, I'd love to hear from you. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.